Welcome back, everyone. Thank you all for joining us today as we do our weekly live update on the global markets, and we're going to take a look at July and what we see ahead, really, for July and August for the summer. Thank you, everyone, for joining us on these weekly calls. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management, and always the information that we're going to review here is really just for your own education. Don't take it as advice. Everyone's situation is unique, and always reach out to a professional or do your own due diligence before acting on any strategy in your portfolio or financial planning. And always feel free to reach out to us, even as to clarify some information that we go through here. Take a look at your individual situation and see how it might apply to you. Or any questions in general, always feel free to reach out. As always, your computers are automatically muted and videos off, but if you'd like to ask a question, just click that Q&A button if you're on the live viewing of this, and type it in. We'll try to get to it today, or we certainly will follow up with you to answer them. And if you're watching this on the recorded version, you'll be able to see down below there will be a link to our contact information, or just go to mikeonmoney.com and that'll take you right to our contact page, where you can reach out to us, book an appointment, or access any of our other videos and educational material, or our weekly reports that we put out on Mondays. Thanks, everyone. We're going to dive into things just as the information as we get started here. I am going to take a bit of hiatus here for the next couple of weeks for July, and it's not because we haven't had great feedback on these things. Just information in the summer is a bit slower, as people normally go on vacations, but information is a bit slower in July, so just not as much to update. If there is obviously anything very important or breaking, we will send out an update, and we'll do our Friday videos, and we'll send you a link to those as well. But I'm going to take a little break on the weekly updates, just as we get caught up a little bit here with information. But I will cover most of what we need to know for July in today's session. So let's dive into it. Sorry, a little off. I was allowed to leave the house, so I was away for the weekend. I had a long weekend, took yesterday off. I was up in Whistler enjoying some socially distanced in the sunshine. So finally got a nice beautiful day up there in Whistler, and weekend was not bad but beautiful. Hopefully everyone here got to enjoy something, but did get out finally of the house and enjoy some outdoors, and Whistler has reopened, so it was quite nice. For all our viewers who are across the country and back east who have had a lot of sunshine, well, good for you. We have not. And we just finally got some for a couple of days. But again, let's dive right into things. So as I mentioned, not much coming up as far as economic news this week. As we are into the summer months, tends to be lower volumes, less happening. We are looking for the retail sales index to come out, and also the purchase and manufacturing index for June come out later this week. As far as the coronavirus, we continue to see high numbers in the US. Not a lot of change from last week on that front. Most reopenings are continuing. Some have slowed the reopenings or returned to closures. So some areas of the country have started to close up some of the restaurants again, and different areas of service, just as those numbers spike. And we're seeing that mostly in the more densely populated states, as of course higher risk of overwhelming the hospitals in those areas with the higher populations. So we'll continue to keep an eye on that as that plays out, and we will see some impact of that as we go later into July here. Unemployment is expected to reach the highest since Great Depression. Now, when we say that, it already has, but that more on a temporary basis. But it is expected to plateau at a number higher than the Depression, despite some better than expected news in the last few days on the U.S. employment front. But again, that being as we've always talked about through these sessions and for the last few weeks, we do always, there's that surge, that pent up demand, right? As they reopen, a bunch of jobs do come back. So it was a bit better than expected. But we'll discuss, there is still some permanent or longer term job losses that are expected to be in the double digits for up to 2 years, maybe. We've seen some reports looking at 2022. New York, as I mentioned, the states continue with the reopening. We'll dive into what that means for New York because they were a hot spot and they are being very cautious. EU is warning that the scale of the downturn is much higher than predicted. And if you've been following us, this is something we've been expecting. We had the government stimulus kind of shore up the economies, shore up spending, keep businesses open. But as we see the real damage out of the closures, it's going to be longer and harder than initially probably thought, based on what we saw with the early market numbers, as they were very much propped up by government spending and printing money around the world. The service sector in the U.S. shows signs of some recovery, so that's the reopening. Again, just a bit of that pent-up demand. Everyone wants to get out. Everyone, needs to go out and buy some things that they haven't been doing for a while. But on the other side of that, we are seeing the spending numbers quite a bit lower than pre-COVID. So the signs of recovery, they're coming off the bottom, which is great, but still not where I would say that we're out of the woods yet on the especially on the service side of things. What else are we seeing out there? Well, corporate America is, a lot of pressure on corporate America with their earnings to put out their diversity data. So looking at their leadership and their hiring practices, and this is on the tail of the protests, not surprising. Some companies are going to look better than others. But there's a lot of pressure for corporations to make it mandatory in their financial earnings and the reports. And if you ever want to really see what that looks like, most of those corporations, when they put out a financial, in the first couple of pages, they usually have pictures of all the board members and the senior management, and usually you can see an indication of what the company looks like just right there. But we'll see more and more of that as the world, not just the U.S., moves to more diversification and more diverse employee hire and training practices. Delta Airline is having some growth troubles, and again, not a big surprise here. I feel like I say that a lot. They entered a partnership pre-COVID with Latin American Airlines, which has filed for bankruptcy. And this is common among the airlines, rather than to overexpand to keep their balance sheet a bit stronger. They strike partnerships or buy into other smaller airlines around the world where they have say in some directional control, but it's not a full-out acquisition or full-out ownership. But of course, they are at risk of the balance sheet of those other airlines, and we're seeing that with Delta, and we'll probably see that more and more as the global airline industry definitely see a contraction there, as more and more of them struggle to reopen and fill the seats. And I think that's even apparent here in Canada, where Canada and Air Canada and WestJet, my apologies, have dropped already or they've pushed for drop, and I know there's a lot of pushback. I haven't heard that they've reversed it yet, but they're dropping the empty middle seat, so the COVID spacing, in favor of having the planes just running fewer planes with more people in it, because of course running, much like restaurants running at 50% capacity, is not very financially lucrative. So the airlines continue to be challenged around that. On the oil front, traders, was reading this report, they're using Apple data and Apple Maps as kind of a way of tracking oil around the world. everything from looking at where the tankers are, the ships are, where they're moving, and even some thermal images of the pipelines to see how much was moving through the pipelines to storage tanks. And they continue to look for new ways to get this data. And that's, I think, just an indication of how bad the oil industry has been hit, despite a little bit of rally, although off a little bit last week, a little bit of rally in the pricing, but there's still a lot of excess supply, and the demand just not increasing the way that certainly that sector would like to see it. As we mentioned, the cases continue to rise in the U.S., especially as the reopening continues. They just had the 4th of July, and if you followed any of that, of course, there was a lot of crowds. We've even seen now, people who have COVID, going out, willingly going out into crowded areas, and we've seen some push for laws around protecting people. Obviously, maybe not purposely infecting other people, but certainly not nonchalantly not taking precautions to prevent the infections of other people. So more and more in the U.S., we see those numbers rise, and I can't remember how many days they've now gone with record high infection rates, but it continues. So we'll see probably more backlash from that as we go through July here. Unemployment numbers, I mentioned, we're expecting to be quite high, and there's that one report I mentioned talking about 2022 being the earliest before we start to see them really get back to normal. Certainly, the majority of the reports are late 2021, so 2022 is not that far past that. But really not looking at anything improving, significantly improving anyway, for the balance of 2020 on the unemployment front. And this again goes to what we've talked about previously, that disconnect between the stock markets or the financial markets and the actual economy. And I'll dive a little bit more into this when we break down those unemployment numbers, because they did come out a little bit better than expected, but and we haven't got all the data, so I didn't put anything real concrete in here. So this is a little bit of opinion, a little bit from what I've been able to read in different reports. But those numbers, those better than expected numbers, were not really well diversified across the income classes or even the social classes in the United States. In fact, it looks like they were very, very focused into concentrated areas, the bigger cities, and the higher income. So you kind of that labor market that drives a lot of the U.S. economy. Remember, the U.S. economy is largely built on people who earn $50,000 and less a year, much higher than you'd find that in Canada. So the disparity between the higher income earners and the lower income earners are wide, and we're seeing that in the unemployment numbers, where the people who need it the most are the ones that are not getting it. And the other aspect that really isn't being played out on all this that can really affect employment is most states now are lifting their ban on evictions. So a lot of people who haven't been able to pay the rent. Remember, in the U.S., it was the rent was just delayed. Some landlords, for sure, worked with their tenants to either discount or get rid of 1 or 2 months rent. But a lot of them, certainly the majority, was just a deferment. So those back rents are now due, and the courts are now starting to hear eviction processes. So as that runs forward, and more people get evicted, more people potentially end up homeless. Puts a lot of pressure on trying to get a job if you don't have a steady home or place. So it's quite hard to get back into employment, and that eviction also goes on your record down in the U.S., your credit record. So when you try to get a new place, it may be even harder. So a lot of things are happening in the U.S. around that, which does not make that the employment numbers or economic recovery look great down there. Private equity firms we're on the list from the borrowing from the government. If you follow that, when the stimulus package in the U.S. went out, There was quite a bit of funds were put out for small businesses to help them pay the payroll protection plan for small businesses to help them get through the shutdown. It was meant for small businesses who were going to be struggling, but what really ended up happening, because it was a first come first served basis, what really happened is larger companies who have accountant firms and have legal teams, kind of jumped through all the bureaucracy faster than the smaller firms did, and got those loans and ate up what was available prior to some of the smaller firms. Not all cases, obviously, but in some cases, and they just made public the list of names there. And there's a lot of controversy around those that may be involved in politics or may be associated with people in politics down there, or just some firms that might not have warranted it. There's a lot of controversy, I guess, around Kanye West's firm getting it or getting a loan from this, even though his firm, he's now worth over $1 billion, and of course he just threw in his hat that he's or says he's thrown in his hat to run for president of the United States in 2020. We'll see what plays out of there. Anyway, New Jersey taking steps to protect the vote by mail. Obviously, a lot of controversy around the vote by mail down there. We saw a lot of states trying to put extra controls around it, or deal even with the concerns around it, because some of the concerns are potentially legitimate, but many may not be, and that will probably continue, as that is a big part of the Republican platform going into the 2020 race about the mail-in vote ballots. As I mentioned, U.S. adds more than 200,000 workers. So this is that job report. They added 200,000 jobs, more than I expected, which was great. But again, that's the part that was partly disproportionate and not really diverse. And again, that's off the bottom. So it's great that it's moving in the right direction, but we're still in strong double digits. Unemployment rates down south. So nothing that I'd overread into that. As I mentioned, on the loan rate, Well-Heeled and Connected were two companies that got some of that $521 billion of loans that went out, and there's many other companies on that list that certainly some people feel were taking advantage of it and did not really need it, and some of those loans don't have to be paid back. So there's a lot. We're probably going to be a lot more fallout from that. As people dive into those reports deeper and deeper as they just came out. EU, as I mentioned, is warning of the downturn being worse than expected. Again, this is something like we're expecting, and nothing that's really surprising or should be a concern for the portfolios. I think as we'll talk a little bit about July, the bigger concern is that the economic news has been a little slow to come out around that. The U.S. business groups are pressing China to implement their trade deal. So remember way back when, pre-COVID, and the U.S. signed a deal with China, trade deal with China. Not a really big change on the trade deal. This was the one where the deal that they previously had was no good, very much like our NAFTA, was no good. They went and tweaked it, minor tweaks to it, re-signed it. So not a lot of changes in there, but a lot of it was around China buying from the U.S., especially in the energy and manufacturing sectors. And of course, through this, they haven't been doing that. And now with all the changes with China and Hong Kong, it'll be really interesting to see how that deal holds up. But a lot of the industries in the U.S. are pushing China to live up to their commitments there, and we'll have to watch that because other areas, obviously, with China and trade have not gone so well and continue to deteriorate with the U.S. And the recent laws passed in Hong Kong are going to put more and more pressure on that on those relationships. As I mentioned, the service sector in the U.S. We're starting to see things a bit better in June. This is really just tagging on the reopening. Of course, the numbers are higher than zero, which they were for April and part of May. So we're seeing them that pent up demand come through in June and looking well, but we'll keep a really close eye on July and August to see where they settle. Do they continue to soar upwards? Do they flat, or do they potentially start to decrease again as some states continue shutdown? As always, we take a look at the numbers around the world. So around the world, we're almost at 12 million total cases, and the death number almost at 550,000. And it seems crazy that we're that high. The U.S. 3 million, just over 130,000. I do want to mention that this list, I go down to Canada for this list, but I've not been able to fit all the countries in there. So there are some more countries between Canada and the US on the kind of a ranking list there. I just removed them because I can't fit them all on here. But if you'd like to see a complete list, I can certainly send you a link to go look at that. But there are a few countries kind of in the middle there that I have to remove to fit Canada at the bottom. We're still doing well, Canada. We're just shy of 106,000, still below the 8,700 number. Of course, BC doing incredibly well as things start to reopen. And as always mentioned, we will see some so the numbers slightly increase as the reopening happens. That's fully expected. We're introducing more contact, which means more chance of contagion. But we want to keep the numbers below our peaks. So if we can still keep it under control, that hospitals are not overwhelmed, we'll continue to do well and have a successful reopening. And that certainly is the trend here in Canada, and hopefully we'll see that continue. So let's dive into the markets. It's funny, as I mentioned, every week, the information here, we try to keep it up to date. It's constantly changing. So, my first and opening line here is the stocks rose last week. They actually reversed that and were slightly down by the end. Pretty much a flat week if we look at it overall. Same with oil. It jumped a little bit, but then pulled back. And it had jumped on that US job data. And then we did see it pull back a bit as the concern of the US infection rates continued to weigh on the market. So, and we saw that here, the US dollar edged up a little bit. And as we've been talking about, that US dollar edging up is just basically the market saying that they're concerned. So it's a bit of a flight to safety. The US dollar is seen to be the international currency. So we see money flow into that when it's looking to protect itself against overall market concerns. And again, gold prices slightly higher last week. Again, that's a hedge to safety, but a hedge against inflation, against all these stimulus packages. Although it did end up slightly higher last week, it is down from its intraday peak. It went over 1,800, and I have it in here, but it's settled at, I think, about 1,780, so just below its intraday high. So we are still seeing concerns in the marketplace with the surge in the stock market prices that we've seen from the bottom. Coming up in the U.S., the Labor Department is going to initial their weekly jobless claims numbers, and this is where we're seeing a lot more, not negativity, but certainly just more realistic numbers, where the unemployment benefits are going up in the millions per week, and that's the labor front. That's kind of the below $50,000 in income levels. Are seeking assistance, having trouble paying rent. Remember, they don't have the CERB down there. They got the one-time $1,200 payment, and even the government's talking about a second payment to people is facing a lot of pushback in the Senate, as they're not wanting to really support that, especially the Republican Senate's not really wanting to support that. So a lot of concerns around that recovery just not being as fast as some parts of the market think it's going to be. We're certainly on the side of that. These numbers just confirm what we think. It's not going to be as fast as the markets would like it to be, but doesn't mean it's danger. It is recovering, and we are following that recovery. Wholesale inventories coming up in the U.S. It's expected to fall. Actually Canada's got some numbers out as well, and this is just on the supply chain being taxed a little bit with the slowdown and trying to get it restarted again. And we're also seeing, especially on the manufacturing side, outbreaks in certain plants and reclosures happening as the reopening moves forward. We're also looking at the release this week of job openings. So how many new jobs out there? And this one, we're really looking or expecting to see some fluctuations, especially through the summer, as mentioned. Some places are voluntarily reclosing for a lot of reasons. Obviously, as I mentioned, the manufacturing, some of them are voluntarily reclosing due to outbreaks. We're seeing that also in the service industry, and a lot in the service industry as well, where some are voluntarily reclosing because they can't profitably reopen without being full capacity, but also a lot of them closing, or not a lot of them, some of them are starting to close just due to the controversy over wearing masks, where they can't get people to wear masks, so they're just saying, forget it, we can't keep our employees safe, we're just going to close because it's not safe for our employees with so much controversy around wearing the mask. Other news out of the US, the job growth, as I mentioned, we've been through that. Tesla, here's a story that's going to lead into kind of the end of the presentation here today. So Tesla had some very successful second quarter deliveries on their cars, and their stock price has surged as a result, as one would expect, although the stock price surged just after these numbers came out. I think, and please forgive if I misquote, I believe it was Barclays Bank and Morgan Stanley in the US came out with raising their target price, so what they think Tesla stock should be trading at. I believe they raised it from about the $270 per share range, and they raised it, I believe they were averaging somewhere around 280 range as where the stock should be trading at. And the last time I looked this morning, it was trading just shy of 1,400. So maybe a little bit overvalued, hard to say, but things have gone crazy on that stock. If you remember last year, there was a big controversy where Elon Musk had tweeted out saying he was going to take it private with some financial backing, and that price was going to be at $500 a share, and everyone thought that that was a crazy number. And now they're pushing $1,400 a share. So a story we're definitely watching, but maybe it might be a bit of a poster child of what we're seeing is some overvaluation, some over speculation in areas of the market. Not to say that they're not having success at that company or they have a good product, but sometimes the prices just don't match or aren't warranted for the true values. Exxon in the energy sector, another quarterly loss, and this is hit mostly in the refinery, which of course they had to shut down massive parts of their productions, so they hit operating loss as there's no demand on this to create the supply for, so we'll probably see that continue. The U.S. Treasury is agreeing on some long-term loans with some U.S. airlines. So they come to terms. So this is not given money, but loans to help them get through things. And they'll have special terms attached. We haven't seen all the terms there, but they did come to a deal. Coty changes the CEO. I threw this one in here. So they hired a former L'Oreal. So if you're not familiar, Coty is a cosmetic company that's gone through a lot of changes, a lot of controversy, a lot of lawsuits. It's been in the news a lot lately. They bought part of a couple other cosmetic lines, and most notably the two Kardashian sisters, their lines. Anyway, there've been a lot of lawsuits around it, a lot of changes, and this marks kind of their fifth, I think, CEO. Since they kind of did a deal with Procter & Gamble about 5 years ago. So Coty continues to have challenges with their leadership. In Canada, the Supreme Court dismissed the appeal of the Trans Mountain Pipeline go-ahead. ruling. So not a big surprise. Took a long time. It's been kind of out of the news for a while with the whole COVID thing, but it's back in the news again. So this is just the federal government saying that they're going to, bought into it, and we're going to go ahead with it. And there was a protest and pushback on that, and so the lower court approved it going ahead, and there was an appeal which the Supreme Court has dismissed. That means the appeal cannot go ahead. So, moving forward with the Trans-Canada Pipeline, such as it is in the current environment. Canada exports jumped in May, which is good. Canada is an exporting country, so obviously the more exports means a stronger economy for Canada. Although our imports were down, but most of that drop in import can be attributed to supply chain closures. And that's just factories being backed up because they had closed down for a while, and just back orders to be filled. So we'll see that hopefully improve in the coming months, and then and as other countries gradually reopen, as well as that supply chain gets better. Alstom ready to sell assets. So this is Alstom, a UK company, buying the Bombardier's train division, but just to meet antitrust laws and approvals in the EU, has to sell part of their assets just to make sure that they don't violate any of the trust or competition rules in the EU. So it looks like that will go through as well for Bombardier. On the currency side, as I mentioned, we did see the US dollar rise a little bit. And again, that's a bit on the uncertainty that we're seeing on the economic recovery. We'll probably see that continue, although it wasn't a big move, as we see, the Canadian dollar still holding at 73.59. I believe we were 73.65 last week. So still fluctuating in that range. If we do see a tough summer in the economies and the markets, you're probably looking at a stronger US dollar, and the Canadian dollar probably slipping back to 71, 72, even if it's temporary. Because when we do see the economies truly recover and show real strength, that's where you'll see the flight out of the US dollar and back into other currencies like Canadian dollars. Oil. So as we talked about, so it was down slightly last week, and the futures are down even a bit further. This is going to be an ongoing story with oil. Really until the airlines really pick up. And I don't mean, opening a new route here or there, but, some real significant reopenings and volumes going. We're probably not going to see demand on oil really surge. I saw a report on the oil rigs being at an all-time low in Canada as far as operation goes, and estimated that as oil recovers, when I say oil is going to have a hard recovery, I don't mean that that the world is or Canada is going to stop using oil tomorrow. Obviously, it's integrated in everything from plastics to fuel. But to get back to those pre-COVID numbers, now they're even estimating that we may never get back to the pre-COVID numbers, just as technology is changing through this. The demand on oil may never get back to the same levels it was before. It will still come back. It will be at a different level, and production levels will adjust accordingly. But it's going to be a bit of a long road, and even that $40-42 barrel range is, as I mentioned, a bit artificially raised due to the shutdown of supply that is sitting there. It's amazingly easy for them to turn that supply back on. So if we did start to see a bit of an uptick in demand, there's really going to be no pricing pressure on oil for a while. So we won't expect that to change much. I would just like to have stayed down a little bit longer at the pump. On the gold front, as I talked about earlier, we did see it up to $17.83 an ounce. Probably going to stay strong. As I mentioned, it did break through 1800 last week. And again, that's just your hedge on inflation and on monetary policies. So, oils continues to be an interesting factor and should be in the portfolio. I mean, it's a good position to hedge, and we'll talk a little bit about that as we go into what's going on in July. So let's talk about July and what we expect, or what you should expect. And again, I am actually very, very positive. If I've talked to clients, we're talking about our current portfolio. I think our portfolios have been in great shape. Not only do they come through this in great shape with some cash positions, the changes we've made through this have done exceptionally well. And what I see coming up here in the summer, definitely going to be able to take advantage of some of this volatility we're expecting. As I mentioned, just because I think the economy is more damaged than it's really reflecting in the market right now, that doesn't mean I don't think there's not great opportunities within that economy as we come out of that downturn. So where do we see things coming in 2020 or so in July and really into August here? I do expect some pullback. So my very first recommendation here is going to be, if you've had some good positions, don't be afraid to trim positions. Don't be afraid to take some profit off the table. That doesn't mean you have to dump a good name. Just take some of that earnings that you've made, if you've made some through this, park that money and wait for a pullback, because we will see some up and down swings. So not that we recommend. Oops, lost my screen here. Let's see if I can get it back. There we go. Not that I recommend high volume trading or market timing. It's simply, if you do have some profits and some really good names, it's a good time to, on good days or good week, it's a good time to trim some of that off. And then when we have a bad week, place it in some other names that you might want to position as a portfolio. And when we look at the names, if we really dive into where those gains have come, and I've talked about this in the past, and I did actually a breakout deep dive on it, on kind of bottom fishing or value, chasing value in the market. And I think one of the things I've really seen out there is this divergence between institutional investors and a retail investor. And your institutional investor is your professional money, your fund managers, your pension managers. And then retail is kind of the individual investor, kind of doing it on their own. And I found this list from a couple different groups, UBS and Robin Track, who keep track of these things. And I think what it really says a lot to what the phenomenon we're seeing out there. There's one chart actually I had read earlier, I believe last week, the week before, and I couldn't re-find again. That I really wanted to put it up, and if I can find it, I'll try to put it into one of our future ones and maybe send it out. But it kind of showed the returns or what was happening with the institutional investor versus retail as far as money goes. And what we're really seeing is that institutional taking money off the table, that trimming, as we've seen the rallies. But the retail investor more doubling down. And the particular chart showed that they had actually made more money than the institutional investor. But what we've seen historically when that happens is when we do see that pullback, who's left holding the bag is the people probably aren't in a position to take as much risk that they are, because they've put themselves out there a little bit further than maybe their own personal risk strategies warrant. And when we look at this list, this goes to really talks to that bottom fishing. So what we've seen the retail investor, kind of go for are the companies that have taken the biggest hits, right? Have the biggest losses as far as the stock market prices going, looking for that big jump up again. And if you listen to that deep dive I talk about, the real money though is going after really good companies that maybe didn't take as big of hit, but are going to surge as they come out of this with a much healthier balance sheet, a much healthier business profile, a much healthier revenue growth. than ones that are, you know, scrambling to prevent losses and damage during all this. And if you look at the top 5 here on the retail side, you know, Ford, where we saw car sales drop 75%, GE, people spending retail appliances and everything fall off. American and Delta Airlines, of course, zero revenue for a few months, and same with Walt Disney. So there's where you see that trend in the, here are the biggest drops. But if you look at the institutional side, picking up Visa, which I've talked about, it's been one of my favorite. My clients have owned it for years. Adobe, kind of your online tools. MasterCard, another big holding in our portfolios. Alphabet, which owns Google, and PayPal, which is also in our portfolios. All those companies, sure, they didn't fall 50, 60%, but they're all, almost all of them are all new all-time highs. So they've not only recovered that, but they're actually growing through this. And that's where you're really going to find your value through July. When we see those pullbacks, it's not on the companies that have been really hardly damaged that you want to try to benefit from. It's really to go to the names that are growing through this, who have a super solid balance sheet. The revenue stream are only increasing, and look for change. You'll notice on this list here, not too much on the technology front. I think you'll find, if you look at, and certainly the technology front has been the faster growth through this recovery. If you look at the NASDAQ exchange being one of the fastest moving exchanges. But those are the areas I think really take a look at, Tesla being a prime example there of an opportunity to take profit off the table and move on to something that's a little bit more realistically valued based on the actual income that the company's making. And just to complete this list out, the only number, oh, sorry, my formatting went off here. But the only name that was on both lists was Microsoft. And actually a great name. It's had a really big run, but at the same time, quite warranted. A lot of pent up sales, a lot of companies move into the work at home models, which means more hardware for people, setting up softwares, more licensing, just overall a good business profile for Microsoft for the next couple of years. Behind PayPal on the institutional side, Salesforce, great company. Again, very much into that mobile work environment. More and more companies have instituted it through this, or expanded their use of it through the COVID shutdown, and I don't see that slowing too much. Alibaba, more people buying online. United Health, of course, health benefits being a big concern. Charter Communications on the technology front as well. On the other side, again, we've got Aurora Cannabis, GoPro, Carnival Cruise Lines, Apple, although I do like Apple, so not really a bottom. It has a new high as well, so maybe not a bad pick on that side. But the few other ones that are above there are definitely ones that took much bigger hits, and they're going to have a much bigger hole to climb out of. So when we're looking for value through the volatility in the summer, don't be looking at the biggest drops. Look at the highest quality companies, and I think on that list there on the left hand side. I hope it's on your left hand side. I never know if it images the exact same way that I'm looking at it. But on the institutional side, there's great names to look for a pullback in through the summer to pick up. As I said, most of those names are already in our portfolios or on our watch list to be part of the portfolios, and take advantage of that through July and August. And that's really what we're looking at for July and August is buy the quality on pullback. And when we see rallies here over the next couple, we will see rally weeks or rally days. It's an opportunity to take some profits off the table. Sorry, how am I doing for time? Not bad. Okay, I got a question here just on the Bombardier transaction. Are they selling? If they're selling the rail division, how can they apply for more government bailouts? Yeah, the Bombardier has certainly been historically the benefactor of government support or subsidies. I don't think that'll change much. It is still a massive employer in Eastern Canada, Quebec specifically. And, you know, they are pretty much one of Canada's only aeronautics companies, and I don't think Canada wants to leave that area of the market. So not likely that we will see that change much. And also, there's a lot of political history behind Bombardier getting those subsidies. So that's probably not going to change either. I think it was just strategic, trying to shore up the balance sheet. You know, even pre-COVID, which this deal was struck, you know, Bombardier was trying to improve their balance sheet situation. Although they've continued to struggle through this. So even with that transaction there, they'll probably still benefit from that going forward. I think I have exhausted my time. It's 12:45. So thank you, everyone. Looking forward to picking these up again in a couple of weeks as we get more information. As I mentioned, we'll still do our Friday deep dives with any breaking news or important information through July. And as always, reach out to us if you have anything you'd specifically like us to cover in the Friday videos. Just send that to us. Follow us on YouTube or social media. We're on pretty much every platform: Instagram, LinkedIn, Facebook, and visit MikeOnMoney.com if you need anything from us or you want to see any of those links. With that, I'll leave you to enjoy your day, and can't wait to talk to you again very soon.